Hi. Let's learn about the Greeks in finance and how traders use them to assess options risk and manage option portfolios. When trading options, it's important to understand the concept of the Greeks. These are variables that represent the various risks associated with options trading. Each Greek is represented by a letter from the Greek alphabet and helps traders assess the risk associated with an options position. Greeks encompass several variables, including delta, theta, gamma, vega, and rho. Each Greek provides valuable information about how an option moves or the risks associated with it. The primary Greeks, delta, vega, theta, gamma, and rho, are calculated as the first partial derivatives of the options pricing model. Delta, represented by the Greek letter delta, measures the rate of change between an options price and a $1 change in the underlying asset's price. It indicates the price sensitivity of the option relative to the underlying asset. Delta also represents the hedge ratio for creating a delta-neutral position and provides insight into the probability that the option will expire in the money. Theta, represented by the Greek letter theta, represents the rate of change between the option price and time, also known as time decay. It indicates how an option's price would decrease as the time to expiration decreases. Options closer to expiration have accelerating time decay, and long calls and long puts usually have negative theta. Gamma, represented by the Greek letter gamma, measures the rate of change between an option's delta and the underlying asset's price. It determines how stable an option's delta is and indicates the impact of price changes on gamma. Higher gamma values mean that delta could change dramatically in response to small movements in the underlying's price. Vega, represented by the Greek letter nu, represents the rate of change between an option's value and the underlying asset's implied volatility. It indicates the option's sensitivity to volatility and how its value changes given a 1% change in implied volatility. Rho, represented by the Greek letter rho, measures the sensitivity of an option's value to a 1% change in the interest rate. It indicates how the option's value would change with changes in the interest rate. In addition to the main Greeks, there are minor Greeks like lambda, epsilon, vama, vera, zama, and ultima, which are second or third derivatives of the pricing model. These are increasingly used in options trading strategies, as they account for complex and esoteric risk factors. Implied volatility is not a Greek, but it is related to them. It forecasts how volatile the stock underlying an option will be in the future. Implied volatility is based on factors such as comparing an underlying stock's historic volatility to its implied volatility, and it is often provided on options trading platforms. A high delta is positive for call options but negative for put options. This means that the delta value is positive for call options, indicating a favorable response to increases in the underlying stock's price. Theta measures the rate of decline in the value of an option over time, making it a measure of its sensitivity to implied volatility. The Greeks are not part of the price of an option, but they are used to estimate how the price of an option might change in response to market or underlying stock value changes. In options investing, the Greeks are values that estimate the various risk characteristics of an options position. They inform traders about how an option is likely to react to market changes and can be used to assess the riskiness of an investment in that option. The Greeks are represented by letters of the Greek alphabet and provide valuable insights into options trading. Here are 3 key takeaways. 1. The Greeks are symbols assigned to the various risk characteristics that an options position entails. 2. The most common Greeks used include the delta, gamma, theta, and vega, which are the first partial derivatives of the options pricing model. 3. Greeks are used by options traders and portfolio managers to understand how their options investments will behave as prices move, and to hedge their positions accordingly. Hope this would help. Thanks for watching.